Alright folks, welcome back to Boss Economics World, the only show that tells you what the guys in the fancy suits are really saying when they open their mouths. Today is October 4th, 2025. Grab your coffee, and maybe something stronger, because the Federal Reserve just handed us a beautiful, gilded invitation to their panic room. You see, while most of the world was distracted by the government shutdown drama, another episode of our political circus, Dallas Fed President Lorie Logan went down to Mexico City and delivered what I can only describe as the most honest, accidental confession from a central banker in years. The mainstream headlines will tell you she was hawkish, that she was cautious. Blah, blah, blah. That's the script. That's the tranquilizer dart they shoot into the market to keep everyone calm. But we don't do tranquilizers here. We do espresso shots of reality. So let's break down what she actually said, and then zoom out to see the five-alarm fire she was pointing at. First, the gospel according to St. Lorie. She said, and I quote, "Right now, we're furthest away on the inflation side of those objectives, with a forecast that takes some time to get back to 2%. Furthest away? Some time? Friends, this is the central banking equivalent of a NASA engineer saying, Houston, the moon seems to be a bit further than we calculated, and our return trip might take a while. Let's put this in context. It's late 2025. The Fed has been chasing this mythical 2% inflation dragon for over 4 years. They told us it was transitory back in 2021. Then it was persistent. Then it was stubborn. Now, the official language is we're furthest away. This isn't a policy statement, it's a quiet surrender. The 2% target is no longer an achievable goal, it's a religious artifact they pray to in public to maintain the faith of the markets. The reality? They printed trillions of dollars. Some estimates put the total M2 money supply increase from 2020 to 2022 at over 40%, and they thought they could just put that genie back in the bottle. What they created wasn't a temporary price blip. They permanently changed the value of the dollar. They permanently changed the cost structure of the global economy. Getting back to 2% from here would require a Volcker-style recession that would shatter the system. And they know it. The current core PCE, their favorite metric, is probably still hovering around 3.5%. So, what Logan is really telling you is, get used to 3 to 4% inflation as the new normal, but please, for the love of God, don't say we said that out loud. It's a managed retreat disguised as a strategic pause. Second, she says, we really need to be cautious about further rate cuts from here. Ah, the cautious word. Let's translate this from Fed speak into plain English. The Fed just cut rates last month. They blinked. The market sniffed out economic weakness, employment growth slowed sharply, and they caved. Now, a month later, Logan is out there trying to sound tough. This is the classic talk like a hawk, act like a dove playbook. Why? Because they are hopelessly, utterly trapped. On one side, you have the inflation beast, wounded but still very much alive. On the other side, you have the colossal mountain of debt. As of today, in late 2025, U.S. national debt is barreling towards $45 trillion. Corporate debt is at an all-time high. Household debt, particularly credit card and auto loans, is flashing bright red. If they raise rates meaningfully to actually kill inflation, the interest payments on the national debt would bankrupt the Treasury. It would trigger a wave of corporate defaults that would make 2008 look like a fender bender. So they can't. But if they cut rates aggressively to stimulate the weakening economy, the inflation beast gets a shot of adrenaline and comes roaring back to life, and the dollar goes into a death spiral. So they're stuck. Paralyzed. They do a little token rate cut to appease Wall Street, then send out a messenger like Logan to talk tough and appease the bond vigilantes. It's not a strategy, it's a tightrope walk over a canyon, and the rope is fraying. Now, here's where it gets really juicy. This is the part of the magic trick where you need to watch the magician's other hand. Logan said she is primarily focused on the unemployment rate, rather than payrolls figures. She points to the 4.3% unemployment rate as a sign of strength. Friends, this is perhaps the most intellectually dishonest statement of the entire speech. This is statistical cherry-picking of the highest order. Why would a Fed president suddenly decide to ignore the payrolls report? Because the payrolls report is telling a story she doesn't want you to hear. The prompt mentioned a sharp slowdown in employment growth. Let's fill in the blanks. That slowdown is likely a reflection of a cratering in full-time, high-paying jobs, replaced by part-time gigs, DoorDash drivers, and people working 2 or 3 low-wage jobs just to pay for their inflated grocery bills. The headline unemployment rate is a beautifully crafted piece of propaganda. It doesn't count people who are so discouraged they've stopped looking for work. It doesn't count people working part-time who want a full-time job. For that, you need to look at the U6 rate, which I guarantee you is probably sitting north of 8% right now. And what about the labor force participation rate? It's been stagnant for years, meaning a huge chunk of the working-age population is just gone. They're not even in the game. By saying we're looking at the unemployment rate, she is deliberately putting on blinders. She's ignoring the quality of the labor market to focus on a single, misleading quantity. It's a desperate attempt to maintain one half of their dual mandate, maximum employment, so they can justify their failure on the other half, price stability. It's a classic shell game. Don't look at the collapsing quality of American jobs, look at this shiny, low number over here. It's proof that our policies are working. It's insulting to the intelligence of anyone paying attention. But all of that, folks, was just the appetizer. The main course, the real bombshell that the media is criminally underreporting, was this little gem Logan dropped. She thinks it's time for the Fed to consider replacing its benchmark rate, the federal funds rate. Do you understand how monumental this is? The federal funds rate is the bedrock of modern global finance. It's the risk-free rate upon which trillions of dollars in loans, derivatives, and financial products are priced. It is the Fed's primary tool, their holy sword, their Excalibur. And a high-ranking Fed official is now publicly musing about replacing it. Why? Because it doesn't work anymore. The plumbing of the financial system is completely broken. For years, the Fed's massive quantitative easing programs have flooded the system with so much liquidity that the Fed funds market, where banks traditionally lent to each other overnight, has become a ghost town. The real action has been in places like the repo market and, more importantly, the Fed's reverse repo facility. Think about it. For the last few years, the RRP has consistently had over $1 trillion parked in it every single night. That's money market funds and other institutions choosing to lend their cash back to the Fed because there's nowhere else in the private market to safely put it. The Fed created a swamp of money, and now they're paying institutions to store that money back with them. The federal funds rate is becoming irrelevant because the Fed itself has distorted the market beyond recognition. It's like a king who keeps issuing decrees, but nobody in the kingdom is listening anymore. So when Logan suggests replacing it with a more widely used market bellwether, likely something based on the secured overnight financing rate, she is admitting a catastrophic failure. She is admitting that their primary tool for controlling the cost of money is no longer connected to the reality of the market they created. This isn't a technical adjustment. This is the Pope considering switching to Buddhism because prayer isn't working anymore. It is a fundamental admission that the post-2008 model of central banking has reached its endgame. They broke their most important tool, and now they're scrambling to find a new one while pretending everything is fine. So let's put all the pieces on the board. 1. Persistent inflation. The Fed is quietly admitting defeat on their 2% target. Higher inflation is here to stay. 2. Slowing growth. They are deliberately ignoring signs of a weakening labor market and a sputtering economy to maintain their inflation-fighting credibility. 3. Policy paralysis. They are trapped by a mountain of debt, unable to raise rates meaningfully without crashing the system or cut them without igniting an inflation firestorm. 4. Broken tools. Their core policy instrument, the Fed funds rate, is becoming obsolete, a relic of a bygone financial era. What do you call an environment of high inflation and stagnant economic growth? Ladies and gentlemen, welcome to Stagflation 2.0. It's the 1970s all over again, but this time with a global debt-to-GDP ratio that makes the 70s look like a paragon of fiscal prudence. This is the inevitable consequence of kicking the can down the road for 2 decades. Every crisis since 2000 has been solved with lower interest rates and more debt. The dot-com bust? Cut rates. The 2008 financial crisis? Cut rates to zero and print trillions. The COVID pandemic? The whatever-it-takes fire hose of liquidity. We have financed our present by borrowing from our future, and the future has arrived. The bill is due. Lorie Logan's speech wasn't a policy statement, it was a quiet reading of the final invoice. So, what's the boss's takeaway? What's the trade here? First, kill the old playbook. The idea of a Fed put, where the central bank will always ride to the rescue with cheap money, is on life support. They want to save the market, but their ability to do so without destroying the currency is diminishing by the day. Volatility is the new reality. Second, your cash is trash. Every day you hold dollars in a savings account, the silent tax of inflation, which the Fed has admitted they can't control, is eating it alive. That 3 to 4% inflation they're tacitly accepting as the new normal means your purchasing power is cut in half in about 18 years. Third, rethink safety. For 40 years, government bonds were the ultimate safe haven asset. But in a world where the government's solution to everything is to print more money and devalue the currency, are long-term bonds issued by a government $45 trillion in debt really risk-free? The bond market is a bubble in search of a pin, and that pin is the market's eventual loss of faith in the Fed's inflation fight. The real assets are going to be king. Things that can't be printed out of thin air. Productive businesses with pricing power, real estate in desirable locations, commodities, gold, even disciplined positions in assets like Bitcoin for the more adventurous. The game is no longer about chasing yield, it's about preserving wealth. Lorie Logan didn't give a speech last week. She delivered a warning. She, perhaps accidentally, pulled back the curtain on the great, rickety machine of global finance and showed us that the wizards behind it are out of tricks, their tools are broken, and they're scared. They'll keep up the charade for as long as they can. They'll talk about being cautious and data-dependent. But mark my words, the system is fundamentally more fragile today than it was in 2007. The only question is what a 2025 vintage crisis looks like. Don't wait to find out. The Fed just told you everything you need to know. You just had to be listening. Stay sharp. Stay skeptical. And I'll see you next time on Boss Economics World.